Welcome to today's panel, where we'll be discussing Mitsubishi HG Capital UK's first sustainable issuance on the Treasury Spring fixed term fund platform in partnership with the London Stock Exchange. So today we're joined by Jeremy Johnson, who is the Treasurer of MHC UK, Kevin Cook, the CEO and co-founder of Treasury Spring, and Sam Dodd, who is a Senior Manager in the London Stock Exchange's fixed income team. So we'll be discussing why MHC UK chose to use the platform for the first time, how it aligns with their sustainability strategy, and then the future plans and expansion for Treasury Spring. Jeremy, I'm going to come to you first. If you could just tell me a little bit about MHC UK, that would be great.
MHC UK is a UK-based non-bank lender, and we lend to SMEs, we do leasing, we do vehicle operating lease, and about half the company is point of sale and consumer lending. We're 100% owned by a Japanese parent, and we're 100% self-funded, which is why I'm so busy most of the time. We have a number of different funding sources, but we can talk later about exactly why we're using this one.
Great. And Kevin, so before we dive into the details of this specific transaction, if you could give me a bit of an overview of fixed term funds and then how the Treasury Spring platform came to be.
Yeah, of course. So Treasury Spring was founded as a London-based financial technology company back in 2016, and we issued the first fixed-term funds through the platform in 2018. But the story starts a little bit before that. So my co-founders and I have been working together in fixed income since 2006. And I guess what we realised through 2008, through the financial crisis, and then in the intervening post-financial crisis period, was that there was a big gap that developed between the options that were available to large financial companies, whether they be asset managers, investment banks, and the rest of the institutional market when it came to what they were able to do both from a cash investment perspective and from a borrowing and funding perspective. And so really the vision for Treasury Spring was to level that playing field. And there are a number of ways that we do that. Some is through technology and providing access in a single digital efficient way for people to onboard once and get access to a broad range of cash investment options or indeed funding sources. But the other way was to build infrastructure, was to really try and solve the challenges of settlement between an institution that might have excess cash and an institution that might be looking for short-term funding, whatever that type of institution may be, and to find a way for there to be a sort of standardized digital pipe for company A to fund company B. And so we came up with this idea that it would be much better, instead of having heterogeneous, complex, difficult, expensive financial infrastructure between every company A and company B, for us to build all of that infrastructure and for us to then give access to that infrastructure to our clients by means of what we call a fixed term fund, or FTF. And so a fixed term fund is think of it as a single security fund instrument where the underlying is always maturity matched to the term of the fund. So a really simple example, which is where we started, would be, I'm a company in the UK, I'd like to not take any bank risk potentially on my excess cash. I'd just like to get access to the UK government. But if I want to do that directly, I need a custody account, I need a dealer, I need somebody to trade it, somebody to settle it, I need a Bloomberg terminal to talk to people. These are all things that most company treasurers don't have. And so for us, they can come to our platform and they can buy, if they wanted 1 week exposure, they'd buy a 1 week UK government fixed term fund. If they wanted 1 month exposure, a 1 month UK government fixed term fund. And then within that fixed term fund sits the obligation that they've chosen. So in this case, the UK government for a week or a month. And so that's where we started. The first ever fixed term fund was issued through the platform 6th of June 2018. But the vision was always to build a platform where people could access the broadest range of the best risk-adjusted cash investment options from the government and government-like or government-sponsored space, but also including banks, where we provide access to secured and unsecured financing, and then finally from a corporate perspective. And so I guess what we'd witnessed looking at the US versus the UK was that in the US you had a very vibrant, short-dated corporate financing market, and it was quite common for large treasurers to put a portion of their excess cash into that short-term financing market. In the UK, the same didn't really exist. And so we really wanted to build an opportunity for clients who had excess cash to be able to diversify away from their banks and place money directly into the corporate sector. but B, for corporates to be able to raise short-term financing from a much broader range of sources than they've been able to up until this point. As we were thinking about launching the market, however, we really saw through 2018, 2019, 2020 a rise in demand for sustainable solutions, whether that be from a cash investment or a financing perspective. And so when trying to launch the new corporate piece of the market, we thought it would be really helpful if we were able to find a way to quantify the sustainability credentials of our borrowers. Now, we're not sustainability experts in any way, and so we looked around the market for where we thought the best independent sources of sustainability accreditation might be able to come from. We had a long-standing relationship with the team at the London Stock Exchange, and so approached them, I guess, probably all the way back in 2019, to start thinking about and talking through the idea of maybe there was the possibility for us to partner where we could use our technology, our infrastructure, our regulation, our client base to distribute sustainable corporate fixed-term funds out into the market. And I guess that's where the partnership with Sam and the team at the fixed income team here at LSE came from.
It works really well from our perspective as well, because our strategy has developed over time as the organisation has grown. I think LSE historically has been a listing venue and not much more, but actually with the merger with Refinitiv, we have access to a lot of data, a lot of resource that we didn't before, and our strategy now really is to provide solutions for our issuers across the entire funding continuum. So that includes looking at private markets where historically, obviously, London's been a public market. It includes helping people with their roadshows through our Spark Live platform, and also includes providing issuers with ESG data, news that they can't access elsewhere but can access through our issuer services platform. So it works really well for us. And through the issuer services platform, we're looking at solutions that all of our issuers can use. And most corporate issuers need short-term funding and have short-term cash investment needs as well. So it was a space that we were looking at, and Treasury Spring, being the expert, seemed like a really good partner to partner with. And the sustainability angle again is key to our strategy. We launched the sustainable bond market in 2015. We now have over 500 active bonds on there, raising $300 billion equivalent for our issuers. We launched the voluntary carbon markets recently. We have the green economy mark, which we'll discuss later. And we're also still developing the market by looking at guidance for green sukuks, which we're working with ICMA and the Islamic Development Bank currently. And we saw that there was a lack of sustainability in the short-term space, just given the nature of the market and the way people look at the use of proceeds in the long-term space. So we saw an opportunity where we could help develop the sustainable piece in that market and help it grow, which is why we chose to partner with Treasury Spring.
Thank you both, that's really interesting. And Jeremy, you're now a user of Treasury Spring.
Yeah.
So before you were using the platform, what type of funding options were available to you?
I said it is very much like commercial paper for us, but it's a lot more interesting because it meets one of our continuous objectives of trying to diversify our investor base. And in particular, with this, we're accessing some investors who we would never otherwise be able to access. So the structure of the fixed term fund, and as you said in your objectives of what you're trying to do with Treasury Spring, really appeals. I think that it's actually probably just scratching the surface at the moment, the amount we do. But I mean, I think some of the investors are actually quite small. The amounts that we want are quite large. So I'm anticipating sort of this is going to grow. But it's an alternative for us. I said it diversifies our investor base. And it's got this additional thing that, as I mentioned earlier, we do actually have an outstanding green bond and a private placement green bond, but they're quite long term and big slugs. And together with the other forms of finance, we have a lot coming in and a lot going out. So we need short term finance to fill in between, and this is just right. And I really like the approach of using investor kind of rating of being, from an ESG point of view, rather than use of proceeds, which is actually quite clunky because our business, because we have a constant repayment agreements, it means that our assets are fully or partially amortizing all the time, which means that if we send it out, if we use the proceeds to create a lease on a green asset or something, that's fine. We can meet the criteria of a green bond that we've used the proceeds, but of course that immediately starts coming back in capital repayments. So, to us, it actually kind of it's like a flow of fixed fund things, and we needed something which fits in between. And this is additionally, it's really helpful to us to be able to communicate to investors and point out the kind of our green credentials or ESG credentials, and that's why it meets kind of several criteria for us.
So we've heard a little bit there about some of the benefits, but I'd love to hear from yourself. What do you think are the benefits for companies that are looking at using the Treasury Spring platform?
Yeah, so I think the first thing to point out is that Jeremy's and MHC UK's financing is somewhat sophisticated relative to a bunch of different companies, in that there aren't actually very many non-financial companies in the UK that have a commercial paper programme at all. So even by having a commercial paper programme out into the market, you're ahead of a lot of UK companies. Obviously have funding needs in different currencies, and been accessing the capital markets for a long time. As I said, that's not typical. And so for us, the first thing that we're often doing to people is educating them on the fact that capital markets financing can be a very useful addition, not necessarily alternative, but addition to the financing that they'll receive from their banks, whether that be via revolving credit facilities or working capital lines. The second thing that Jeremy mentioned is diversification. So our clients are typically anybody from FTSE 100 corporations all the way through to SMEs, and in between we have charities, we have family offices, we have private fund managers. These are people who typically aren't banks and don't buy commercial paper. And so even if you do have a commercial paper programme, as MHC UK does, the investors that you access through that will be very different to the investors that you access through our platform. So today we have about 370 clients. I think I can confidently say that none of those clients buys commercial paper at all. So that's 370 people that you'd never reach through a commercial paper programme. Yeah. And those, from a financing perspective, those people are often uncorrelated to the banking sector, uncorrelated to the asset management sector. And so the risk, that I guess most treasurers, CFOs are often trying to protect against is, what happens if all the taps get turned off at once? How do I make sure that I've got contingency and redundancy?
Don't say that worries me, but that's exactly what it is.
And so for us, what we're enabling people to do is to have another option to make sure that there's always liquidity that can flow from different sources. I guess the aim also over time is that as we build and the market builds, there should be pricing benefits to this. And maybe we can talk a bit more about sustainability pricing benefits and greenium and how that sort of thing might play in as the market develops. And then the other thing is ease of execution. So, building a commercial paper programme or doing any form of capital markets financing generally is pretty cumbersome and time consuming and expensive. And so what we worked really, really hard on was coming up with an easy way for people to do this, a better way. And so we've got a standardised short form loan agreement, which is sort of 15 pages, and of that, 8 pages is boilerplate. And then once you've done that, you onboard to the platform, very simple process, and then you can immediately get access. So it's a very lightweight from a onboarding and integration lift perspective. And then I guess sort of finally, which Jeremy touched on, is the sustainability benefits, but maybe I leave Sam to talk more about.
Yeah, exactly, and all the benefits you've just listed is what we're trying to provide to our clients as well. So again, it fits in with our strategy, and as Jeremy mentioned, the use of proceeds, popularity of that format in the long-term bond space doesn't work for the short-term debt space, because it's rare that you're going to be using money that you've borrowed for 30 days to build a wind farm or something like that, or put into a green asset. So it doesn't quite work. So when we were developing the accreditation and thinking about how we could help Kevin and his team, we were looking at issuer level criteria. How could we say that at an issuer level they were working towards sustainability goals? So the 3 criteria that we came up with, using the resources that we have and the data that we have, were using the green economy mark, which we give to our listed issuers that have 50% of revenues coming from resources that focus on environmental objectives. We have LSEG ESG scores, and we said that anyone that has a score of B+ or higher would qualify. And lastly, using the sustainable bond market, which I mentioned before, if an issuer is listed on there and their ICMA framework aligns to the green or social bond principles of 2021, or the sustainability linked bond principles of 2020, then they would also qualify, because those ICMA principles have the qualifier that you need an issuer level strategy to align with those. So it simply can't just be a use of proceeds bond. You have to, as a company, demonstrate that you're doing more, and that's what Mitsubishi have done there.
Just to maybe add a couple of things on that. So from our perspective, when working with Sam and the team to construct this, I guess people are quite familiar generally with credit ratings and credit markets, and there's this concept of being investment grade from a credit perspective, which generally means you're in the upper deciles of the credit quality that you could have as a corporation in whatever particular sector you might be operating in. I guess the appealing thing of using the LSEG ESG scores was you could use a similar principle, and you could come up with look, this is a company that is genuinely in the kind of investment grade area of its particular industry at this particular time when it comes to looking at sustainability credentials. And then the other thing, looking at the ICMA principles, was it was really important to us that the companies that we work with aren't just doing one sustainability project that they can hive off and have some funds that flow towards, but that as a business they're really working on the green transition, on being a sustainability company at its core. And I think from our conversations with treasurers, from our conversations with CFOs, that's what people were looking for when it comes to the sustainability characteristics of any either cash investments or borrowing that they're taking, was some comfort that when people are reporting internally, they could get their hands on, okay, now this is not just a green issuance, this is a green issuer or an ESG issuer that meets some nice objective criteria that can be measured against.
And so we've had there quite a few reasons why companies might want to use the platform. So I'm curious, what was the catalyst for you deciding to use Treasury Spring?
Well, of course, the charm of the people we deal with. I mean, that was the main catalyst. As I said, I think probably that being ready to hear an alternative, I think, is probably the key, because otherwise you would think, oh, well, I'll just continue what I'm doing. And we referred to that before when we discussed it, is that I think people, when they're investing, etc., tend to kind of follow a path well trodden, and maybe it takes a bit of courage to go and look at something different and say, actually, no, I have to investigate this and find out what the pitfalls may or may not be, or get it cleared from a legal and a tax point of view, etc. But once you've done those things, it's kind of like, I'm just waiting for it to grow even more now.
So we've talked a lot already about sustainability, and we know that many businesses are trying to embed sustainability across their businesses. How are you finding that you're able to embed sustainability in your funding strategy?
We're a taker fund, so it's really what investors want to do. So in terms of strategy, we will move our funding to what the investors want to do. And what I'm finding when I talk to investors, and we're selling longer term debt, is that I would say maybe sort of 80 or 90% of them are not actually actively looking for a green investment. 10% of them are, because they've labelled their fund or something as being green or ESG or sustainable or whatever. But most of them, the key for them is to view that the business they're investing in is heading in the right direction. It's got the right strategy, and and a kind of like, there's a slight negative filter to that, which is that they're not investing in what may become stranded assets in the future because of the change in what's happening in the environment, etc. That those assets are okay to invest in, because the transition is very important. But if you are investing in a company that has got those kind of assets, you need to be looking very carefully about that company's strategy and what their investment horizon is. Because if you're investing in something which is going to be completely useless in 6 years' time, it's probably not a good idea to lend to them more than 6 years, you see what I mean? So I think we're sort of very much adapting to how it's changing in the marketplace. And that's one other comment I would make is that the ICMA principles, the other principles, the use of proceeds, or whether it should be kind of more orientated around is sustainable issuer, as it were, rather than the use of proceeds. All those things are kind of changing all the time. It's quite new, and as those things change, then we will change as well.
That's a point that the fact that everything's changing is something that not only have we witnessed idiosyncratically, but we saw in the results of the surveys that we've done over the last couple of years in partnership with the LSE in relation to sustainable cash investing and sustainable finance, which is that there's a significant demand for both. I think people feel the pressure internally that they should be looking at these things, but there's a clear lack of direction, I think, in the market. There's a lack of certainty around what sustainable financing or sustainable cash investing is supposed to mean. And that's natural because it's we're relatively early in the evolution of those markets. But I think it's very clear that they're only going to evolve in one direction over the course of the next 5, 10, 15, 20 years. I remember listening to Julia Hoggett, the CEO of the London Stock Exchange, talk about the development of new markets and describing them as a sort of five-year process, which is it's 5 years to figure it out, get it into place, actually build it, and then another 5 years after that before you really get adoption of it. And I think that's where you kind of are in the sustainable finance, short-term financing, and sustainable cash investing markets. Sustainable bonds, obviously, much further along. But that's why I think it's super important to be able to have objective standards that people can hang their hat on and aren't going to sort of blow in the wind from week to week or month to month, which I guess is why we settled on the criteria and the partnership that we did.
You've kind of touched on it a little bit already, but what do you see as some of those challenges that your clients are facing, and yourself as well, in embedding sustainability, other than the fact that this is a long-term strategy?
Me or Jeremy?
Whoever wants to answer first.
I was a little bit kind of, when you say what are the challenges, I was kind of like a little bit shocked to discover just how much it cost us to do the green reporting. And I mean, maybe it's because it's early days and because it's, we're used to spending, a shed load of money doing our financial reporting, but obviously that's essential. This is kind of like an extra thing, and suddenly there are a whole bunch of other people that are there to do it. And maybe that's going to get more refined and more integrated into our financial reporting. And I think when it does get more integrated, then perhaps it won't be so obvious what the additional cost is. But there is, surprising additional cost to it. So that's a bit of a challenge. Yeah. And there's a slight, it's not no big deal, but obviously you've got to go out there and measure. You have to sort of start recording additional information about your assets, which, because obviously we've got gazillions of assets, because we've got some very, we're not in the consumer space because we don't actually ask people what they use their loans for, but in the rest of the other half of the company, we have to say, okay, is this, what's the CO2 emission of this car? Is it meeting the kind of criteria? Because at the moment, you can include hybrid cars, but not. But I think it's within 2 years or something we won't be able to include those anymore in what is classified as a green asset. So, it's kind of there's additional work, I suppose. But then I would moan about that, wouldn't I?
No, I can certainly relate to that. So I work in our sustainability team, and there is a huge piece of European regulation at the moment called CSRD, which you may be familiar with. Coming, it's on its way. Yeah. And as part of that, the maximum amount of disclosures that you have to make is over 1,000 different pieces of information. And so this is just an immense amount of work, which is increasingly coming towards our finance teams.
And I think, again, as you're in the infancy of a market, if people aren't sure exactly what might be important to collect over the course of time, the temptation is to say, well, let's just collect everything, and then we'll refine that, which maybe from a regulator's perspective or from a market development perspective can make some sense, but for the fact that the people who actually have to go out and collect the data might then be dissuaded from doing it because it's too much of a burden and too much of a hurdle. And so I think there's definitely a challenge with that. I think, as well as the lack of direction that I mentioned a little bit earlier, taking that to its extreme is a fear of greenwashing, which we definitely saw probably 2022, 2023, we saw, you'd had this groundswell of importance being attached to sustainability, and then people either really trying to do the right thing or jumping on the bandwagon, sort of depending on who you're talking to, and then some people looking and saying, well, no, actually that's not what we mean, and that's not what the market thinks is an appropriate benchmark for sustainability. And so I think for a lot of people who were kind of already in the process of saying, okay, I really want to do this, I want to embed it, it's important for us, it caused a lot of people to step back and say, okay, I'm trying to do the right thing here, but I'm worried that in trying to do the right thing, I'm actually going to be criticised or for getting something wrong. And because there's that lack of direction and clarity, do I have the incentive to step forward and try and do this, or am I better to just sit back and let other people take those steps for us? And so I think that's definitely a challenge for people, and I guess that's why we're grateful to people like the LSE and to MHC for, I guess, putting our heads above the parapet a little bit and saying, this might not be perfect, I'm sure it's going to iterate, and I'm sure we'll get to a point that in some years might look slightly different to it does today, but we're all trying to do the right thing, and we all believe in this, and therefore we're going to kind of vote with our feet to some extent.
The other challenge I think that we're seeing is with the development of the market, the sustainability linked bonds, we're seeing more and more of those, and trying to choose KPIs that are aggressive enough, I think, is a real challenge for corporates, because they don't want to be seen to be gaming the system and choosing very achievable targets, but they also want to make sure they do achieve them and don't have to then pay that coupon step up. Now, I think you'd argue that if every single sustainability linked bond hits every single target, then the market isn't being aggressive enough. So I think you would want to see some people not hit their targets at a group level, rather than, I wouldn't want it to say I want that issuer to fail to meet its targets. But I think generally for the market it would be quite good. But I think investors are still trying to decide what's aggressive enough, and I think corporates are, like you say, corporates are looking at what the investors want. So I think there's that back and forth at the moment.
I would say, from my experience, that that is a trap to go down, to say, okay, I'm going to achieve this target. Is it? I would question whether it's really worth it, because on our bond issuances, we find maybe on a public deal you get sort of 2, maybe 3 basis points advantage from it being a green bond from not being so. And if you consider the step-up cost of not meeting that target, then that didn't really pay off, did it, to do?
And it's a really interesting calibration, isn't it? Because Sam and I were having a conversation with a treasurer who should remain nameless, who sort of said, I feel like from a philosophical perspective, I should be almost setting these targets at a level where I expect to fail, because that's what I should be doing as a company. But if I do, economically, that doesn't make any sense, and that's my job. And so I think these are the things that we have to kind of work our way through, and the market has to centre in on. But it takes people to try in order to be able to find the truth.
So taking us back to this debut transaction, which has been a really good example of the partnership with the London Stock Exchange, Sam, what do you expect from the future and the expansion of this partnership?
Yeah, I think from our perspective, from the LSE, we want to raise awareness. We want to make sure all our issuers know that they have this option for them. As you said, we want to ensure that everyone has a diversification of funding sources, of investors, and all markets are available to them. So raising awareness is going to be a big piece. And I think, unfortunately not everyone's like Jeremy and the team there, where they're willing to try these new things. But now that we've actually moved from, away from the theoretical to actually a real world application of this, I think we will start to see some fast followers that are, have seen the success of it from Jeremy and his team, and are then willing to take that leap and do it as well. So I think it's a bit of a snowball effect where we'll see it start to grow. As well, just from a macroeconomic environment, with rates going higher, with cost of funding being higher, the potential benefits of using a Treasury Spring platform is going to be greater. So again, people are going to be looking at it more closely and seeing how they can reduce their cost of funding, and that's going to be through diversification of options, choosing what's right for you in that moment. So yeah, for us, it's going to be ensuring that everyone knows that they can use this.
I guess from my perspective, I view the corporate issuance and the sustainable corporate issuance piece of this as a little bit of a microcosm of our broader business. So as I mentioned, we started the broader business back in 2016. It took 2.5 years to issue the first fixed term fund. We grew at a reasonably fast but not stellar rate for the first period, because it took a while for people to get their heads around this and to trust the adoption of it, and for people to do the cumulative due diligence, whether that be legal or operational or tax or what have you, in order to get their heads around it. And then sort of once we were a little while into it, we really saw it start to take off and reach a tipping point, and there was market adoption, to the point where today, as I mentioned, 375 clients, up from probably 118 months ago. And we've also seen total issuance through the platform really skyrocket. So we've done the best part of $100 billion worth of issuance through our platform across all of the products that we offer. And so I guess we view this in the same way, which is, we're very grateful for our early adopters and the people who've helped to build the first iterations of it. But there's no reason why, if you're any corporate originally in the UK that has an investment grade credit rating that's looking to raise short-term financing, this should be a tool that should have some application somewhere in your toolkit. So that's the goal for us. And then beyond that, moving also to companies that don't have and haven't issued any capital markets financing before. So interestingly, through COVID, we saw the Bank of England have to rush to create the CSSF, in order to, CCFF, collateralized commercial funding facility. There we go. Difficult acronym. But that was because they realized that there was all of these corporations which were important to Britain, important to the country, that suddenly were very dependent on a banking sector that they didn't know how it was going to play out through COVID and what the impacts on that were going to be. And so you ended up with a lot of these sort of quasi-commercial paper programs being set up in order to solve this potential problem. But if this had existed back then, you wouldn't have needed to worry about that. And so that's the vision, is that really, to get to a point where it becomes a part of everyday financing for corporations originally in the UK, and then beyond that as also.
Well, from my point of view, I mean, all I do all the time, we're trying to access investors. I mean, that's the key. And this is a way of accessing some investors I would have never, ever been able to get anywhere near. It just works. I think it's very efficient. The point is to access those investors as efficiently as possible. If those investors go via anybody else's balance sheet, then that's going to be an economic cost to that. There has to be reserve asset requirement, etc. And you're just like you're paying up something and you're losing something between the investor and the borrower. So I'm going to use that word that I think was quite common in the 80s, which is disintermediarization, which I can just about say. And that's what it's about. And it's about using and applying technology in that Treasury Spring is using. It's partly technology, partly the structure and how it's done and how it's structured through the Channel Islands, etc., through a very neat bit of use of law, which seems to work very well to us. I think it's got all the hallmarks. And I believe there is, I may be mistaken, but I believe there's an awful lot of unutilised cash out there in sort of the world of business and SMEs and sort of slightly larger companies. And I think this may be a way of very efficiently accessing that. And I sort of, my hope is wrong, but I think it is actually quite big, because having discussed it with sort of like a number of banks and etc., of they're saying what they have as deposits and what's actually ends up sitting around on accounts, and occasionally, dare I say it, what we have left sitting around on accounts, very disappointingly. I think actually this could go a long way.
Maybe just one thing to conclude on that, to give an idea of where it might go. If you look at the US market, for example, I think the volume of corporate commercial paper issuance is more than 50 times greater than it is in the UK. And obviously the US market is bigger than it is in the UK, but not by anything like that scale. And so I think there's an awfully long way for us to go in terms of non-financial issuance of short-term debt. But commercial paper was, from a time a little earlier ago, with a slightly different, more clunky legal framework, less technologically advanced. And so hopefully this can be a good tool for people going forward.
Great. Well, thank you all very much for an interesting discussion today, and congratulations again for the debut
Thank you.
transaction on Treasury Spring.
Thank you.
Thanks very much.
Thank you.
Thank you.